Good morning to all those joining us from all around the world. My name is Rahim, and on behalf of DD Consulting, it is my pleasure to welcome you to today's webinar of IFRS 17 and its intersection with IFRS 9. And I'm pleased to inform you that we are joined by 100 participants from all around the world. Implementing IFRS 9 and IFRS 17 has been one of the most ambitious and transformational shifts in financial reporting for insurers and financial institutes worldwide. In this webinar, we will explore critical role actuaries plays in supporting auditors, particularly in jurisdictions where the first IFRS 17 audit cycle has begun. We will also unpack the complexities of IFRS 9 and how it applies within the insurance sector. As a bonus, we have joined by a speaker from Australia to share their implementation experience, offering valuable insights from Australia, a market significantly ahead in IFRS 17 implementation, allowing us to learn from their experiences and challenges. Before we begin, a quick note, we will have question and answers in the end. To begin our session, it is my honor to introduce our first speaker, Mr. Hussain Feroz, the CEO of DT Consulting. With over a decade of leadership and experience in actuarial consultancy, Mr. Hussain has led IFRS 17 implementation projects across several markets. He is a qualified actuary and has worked with several reputed auditors in the region. Over to Mr. Hussain.
Thank you, Rahim, and good morning, everyone. I'm really excited to be speaking about the role of actuaries in the IFRS 17 audit, and thank you for joining in such large numbers. I think I can see on the chat that some people are having problem with the sound, so I think maybe Rahim, you or the team can help them with this. So while I start my presentation. Okay. So to start with, in the past, as we are aware that financial reporting and audits were largely accounting driven, IFRS 17 has reshaped the way insurance companies report their financials. It is a principle-based standard, and it requires a lot of interpretation, judgment, and a deep understanding of insurance cash flows. It introduced new concepts like the contractual service margin and risk adjustment, as well as several detailed disclosures. Actuaries with their technical modeling skills and insurance domain knowledge are working hand in hand now with auditors to validate these outputs. In several markets, regulators are encouraging or even requiring stronger collaboration between auditors and actuaries to ensure the reliability of IFRS 17 numbers. And I will tell you the reason for this. The reason is the risk of material misstatement is very real now, as we are now dealing with a lot of assumptions and judgment. So let's unpack this role further and take a deeper look at the specific areas where actuaries contribute during the IFRS 17 audit process. In fact, I will just take you one step backward first before moving forward. I will ask you to think about why auditors will involve any subject matter expert in general, such as actuaries. So international accounting standards already recognize that auditors may require the help of subject matter experts in specialist fields. For example, insurance. There is ISA 540, which deals with auditing accounting estimates, and there is ISA 620, which governs the use of experts. Both of these provide a framework for involving experts like actuaries in complex audits. Within IFRS 17, when you look at areas like risk adjustment or future cash flow projections, it is very clear that specialized actuarial input is not just helpful, it is necessary. In fact, the Actuarial Association of Europe has advocated for making actuarial involvement mandatory in IFRS 17 audit, given the complexity. Before the first official IFRS 17 reporting happened, many insurers went through, or in some of your markets are planning to go through dry runs to test how well their systems, assumptions, and methodologies held up under the new standard. This phase is where actuarial review is most valuable because it allows companies and auditors to identify and fix issues before they become audit findings. There are typically three areas we focus on in actuarial review. First one is technical methodology papers review. Second one is transition opening balances review. And the third one is IFRS 17 financial statements and disclosures review. To begin with, the methodology paper review lays out the methodology papers in general lays out the company's interpretation of IFRS 17, their chosen models, whether it's GMM, PAA, or VFA, and how they handle key concepts like coverage units and risk adjustment. We often find gaps between what is documented and what is implemented in real. Then transition balances are another critical area. Whether a company uses fair value or modified retrospective approach, the assumptions used and the transition impact on retained earning must be closely examined. Finally, we review the financial statements and disclosures to make sure reported numbers like CSM, LRC, LIC, etc. are all aligned with the underlying models and assumptions. We help auditors validate these numbers through movement analysis and data tracing. Now I will go further deep into our review process. So one of the first things to review by the actuaries is the underlying methodology and accounting policies. The technical paper is generally the company's rule book for how they have implemented IFRS 17. We check whether the measurement model chosen for each product is appropriate and supported by eligibility assessments. Then we review methodology documents to see how things like CSM are calculated, how coverage units are defined, and how assumptions are updated. Practically, we often see inconsistencies between policy documents and system outputs. That's where we step into and flag those early issues. Once the methodology is well understood, we dig deep into the assumptions. IFRS 17 relies on a whole range of actuarial assumptions like mortality, lapses, expenses, and financial ones like discount rates and inflation. One area which is risk adjustment methodology is key to analyze. Some companies use cost of capital approach, whereas others use MAC model, or there are other alternate approaches also available. Our job as actuarial audit reviewer is to make sure that the chosen method is clearly defined, consistently applied, and produces results in line with market practice. To give you one example, in one case within our review process, we observed that an insurer failed to reflect diversification element between portfolios while calculating risk adjustment, which overstated the margins. We helped the insurer correct that problem. The final step is to review the outputs or the actual figures reported under IFRS 17. We help auditors verify the balances like LRC, LIC, and CSM. We perform roll forwards checks on the CSM to make sure it's adjusting correctly for new business, interest accretion, changes in assumptions, and insurance revenue. We also validate that the disclosures in the financial statements align with the outputs. Now, I wanted to talk about the key technical focus area that we as actuaries keep in mind when we do the audit review. The first one is the contractual service margin or CSM and the loss component. These two are some of the most technically challenging areas under IFRS 17. The CSM represents deferred profit. It needs to be calculated correctly at contract inception and amortized properly over time. What we do here, we check whether the CSM is set up using accurate present value cash flows, less risk adjustment, and whether it's adjusted for interest at the locked-in rate. If a group becomes onerous, a loss component is created and CSM goes to zero. Then the second part is the risk adjustment calculation. Some of you may be familiar with the Solvency II framework and the risk margin requirement within Solvency II. Now here, when it comes to IFRS 17, the risk adjustment calculation or approach is entirely different. It is no longer a formula-based approach under IFRS 17, whereas it's a principle-based approach, which introduces additional element of uncertainty. We assess whether the risk adjustment method and the confidence level make sense for the portfolio and is consistently applied. We often benchmark the resulting risk adjustment value against industry norms. For example, if a company claims that their risk adjustment corresponds to the 90th percentile, but the amount seems too low, we can do the benchmarking to validate this assumption. We also check whether the diversification benefits are reflected properly. The third component is the discounting, which is another technical area. I think in the life insurance context, companies were already, even in the older standard, using discounting. But in the non-life insurance or the shorter term products, discounting in the context of technical provision has been introduced as a new component. And if you are a non-life insurer, this is something that you need to do it rather more carefully. So when it comes to discounting, we evaluate how the insurer derived their discount curve. Did they start with a risk-free curve and added a liquidity premium? We also check the extrapolation methods because what happens oftentimes, the insurer handle yields beyond the last observable point using some approximation. So it is our responsibility as audit actuaries to understand and validate the extrapolation method. The next component is the data quality and cohort grouping. IFRS 17 required contracts to be grouped into cohorts by year and profitability. Here, we often find issues such as grouping of contracts which are issued more than a year apart, or mixing profitable and loss-making groups together. We perform sample testing to validate grouping logic and check whether it hides any loss component. The final component is the presentation and disclosures. Here, we are looking into actual numbers and we are trying to make sense of the final reporting numbers. We also do review of the financial statement notes. Are these notes complete? Do they match the underlying data and methodology? Are the required disclosures like risk adjustment confidence level appropriately provided, or the CSM movement disclosures and the yield curve, have they been clearly explained? Auditors in general value the role of actuaries and help here because connecting the model outputs and the results to what ends up in the notes in the financials, this is a task that bridges both domains. Now, also wanted to touch base on the overall review process that we follow whenever we start working for a audit review assignment. So let me now walk you through the entire review process, which we within our company as part of TD Consulting team follows. This process has been developed and refined through multiple engagements with audit firms in the region, and it has proven to be extremely effective. So you may probably also use this to benchmark your internal process. So our first step is to begin with data request, covering policy level data and assumptions to model outputs and methodology. For life insurers, we may request cash flow projections, assumptions, or assumptions like lapses, expenses, and sometimes even the screenshots of system logic. What is critical here is to identify any data or documentation requirement. In the next slide, I will also show you some of the checklists that we work with auditors and we try to arrange that information. So I have a couple of slides on the checklist also. Then once the data part is covered, we then move into validation and reconciliation side. Here, as part of actuaries, our role is to make sure the data is complete and internally consistent and aligned with IFRS 17 requirement. I would like to mention here that as actuaries, we are required to follow certain standards when it comes to data. So one of the commonly used standard is called actuarial. It's called ASOP 23, like Actuarial Standards of Practice 23, which is on data quality. So actuaries have to, in fact, the actuaries which are part of USA body are required to apply ASOP 23 effectively, and this is what we also apply when doing the audit review process. So once the data review process is completed, then our next task is to work on the data reconciliation. Here, we begin surfacing any inconsistencies or incorrect applications of the standard. Common examples here could be that overstated CSM due to errors in coverage unit calculation, or for example, inconsistent application of discounting method, or sometimes missing documentation for the risk adjustment methodology. What we do here, like once all the observations are compiled, we summarize in a clear and structured format, and we share with the audit team for their initial review. Then the most important step comes, which is the joint resolution meeting. This is where we sit down with the auditors and the client's finance team and the appointed actuary to walk through each of our findings and observations. Here, I would like to clarify one thing, that in the for initial audit reviews, which were done in year 2023, in countries where the IFRS 17 was adopted in 2023, what we observed that the role of appointed actuary was not very clearly defined. So some of the actuaries were not signing off on the results of IFRS 17. And when we were doing the audit review, and when we requested meeting with the appointed actuary, so they were reluctant to be part of the meeting because their role by the regulator was not defined. But fast forward now, in most of the market where IFRS 17 is implemented, I see that the role of appointed actuary is defined. For example, in UAE, appointed actuaries are required to sign off on IFRS 17 assumption methodology as well as the results. So now, whenever we do the joint resolution meeting, we always request the presence of appointed actuary as they are now signing off on this meeting. So the goal of this joint resolution meeting is not just to raise issues, but to offer solutions as well and facilitate a clear path to resolution. For example, I'll give you one example, in fact, from one of the client audit review where we observed some issue on the risk adjustment. They were using a 75th percentile assumption. The insurer had no documentation to justify that percentile. So through our meetings, we helped link the assumption back to their internal risk appetite and capital model. And that's how we completed the overall documentation. So the role is not just to raise problems, but also we work together in these meetings to find the joint solutions. Once the resolution meetings are over and our queries are resolved, we move to the clearance and conclusion step. We re-review any revised calculation or updated documentation or new information received and make sure that all of the prior concerns are addressed. This includes like going back and trace the older checks. For example, if a correction is made to a CSM roll forward, so we make sure that it ties back to the underlying assumptions. Once everything is complete, we inform the audit team that our review has been finalized and cleared. In the interest of time, sometimes we provide our clearance via email to communicate our response formally with the auditor. Once the email confirmation is provided, our final step is to submit a formal report or the audit memo, which includes a summary of all validations, findings, resolutions, supporting documentations, etc. In many cases, our report become part of the audit file, offering assurance to both the audit partner and the regulator that all the actuarial elements have been independently reviewed and validated. I am proud to say that this approach that which we just went through has been successfully used across several IFRS 17 audits. in UAE, Oman, Saudi Arabia, Bahrain, and other countries where we have our DT Consulting has audit clients. Now here, as I mentioned that the first part of the audit process is to work on the checklist and submit the checklist to the auditor so they can pass it over to the team to the client. So I wanted to give you a taste of how the checklist looks like. So this is the summary. This is a high-level summary of the checklist. So I'll quickly go through the items that we request. First is the contract grouping and structure, where we request the list of insurance contract groups, including gross and ceded, and the methodology for linking payables and receivables to contract groups and related cash flow forecast. The next step is discount rates, where we request for an understanding of the underlying discount model and the yield curve used for the reporting period. We also look for clarity if the claim-related liabilities are subject to discounting or not. And we also try and understand how the country risk adjustment or the liquidity premium adjustment has been used. Then for the transition to IFRS 17, we try and understand the overview of equity moments from IFRS 4 to 17. We also try and understand the various drivers of change like risk adjustment impact, discounting impact, or the reinsurance impact on the equity adjustment. The next component is the measurement model application. So we try to understand and find and request clarification on which models have been used for which portfolio and the underlying justification for it. If the eligibility testing is performed, then we request for the eligibility testing information. The next component is loss recognition and profitability review. So we request here the data for profitability indicators like expected loss ratios, expense ratios, risk adjustment levels, and how the overall combined ratios are worked out. Then the next component is risk adjustment, where we request the approach used for risk adjustment. We request for the percentages by portfolio, including the confidence level used. Next component is expense analysis. So as you probably know that within IFRS 17, we have to break down expenses into attributable and non-attributable expenses. So we request for the whole working for expense analysis. We also understand how it is reconciled with general ledger and the historical expense base. The next component is reinsurance, where we want to understand how the allowances have been made for default or non-performance risk. And we also request for all related assumptions and supporting calculations for reinsurance. Then we have the LIC where we understand where we request for expected cash flows at the portfolio level. And depending on the market where you are, sometimes the regulator has defined the templates for regulatory filing. So we request for the underlying templates which the regulator has requested. For example, UAE has a template for IFRS 4 and 4 to 17 reconciliation. So we request for that template from the client. Then for the financial reporting, we request for the underlying results, underlying disclosures, the underlying notes for financial statements. And the last report component is actuarial reporting. So here we request the technical provision report, pricing analysis report, or pricing adequacy report. So any actuarial report which the company has prepared for the underlying period. So we request availability of those reports. Now, moving on, I from our experience of multiple audits and working with multiple reputable auditors, I would also like to talk about some of the common issues that we have identified. So to begin with, when working with insurers on IFRS 17, one of the first things we notice is that some of the persistent challenges are not necessarily technical, but rather they are structural or data-driven or even sometimes process-related challenges. A common area where issues surface is around how contracts are grouped and how onerous contracts are assessed. IFRS 17 is very clear that contracts must be grouped by portfolio and further by their profitability, whether they are loss-making, profitable, or somewhere in between. But in practice, we have found that insurers' internal data systems don't flag this accurately, which leads to incorrect grouping and potentially failure in recognizing onerous contracts. Then the second big challenge is the calculation engine themselves. Many companies configured IFRS 17 models through third-party vendor tools, and while these engines do the job well, especially for reporting, they are not immune to logic errors. During our reviews, we have come across several technical issues. For example, the same set of cash flows accidentally being used twice. We have also seen errors in the discounting being applied twice in projection scenarios. Then there is the risk adjustment issue. Some system fails to apply diversification benefit across portfolio, even if this is mentioned in the underlying methodology. Another issue I've observed is in the calculation of coverage units. Then moving on, the next issue that I have observed is the control and the documentation. When IFRS 17 was first implemented, many actuarial and finance teams were primarily focused on making the numbers work. But doing that, they have often overlooked the documentation. What this means is that the model were built in spreadsheet or custom tools, assumptions were updated manually, and version control was either weak or non-existent. Another significant challenge which we faced across multiple insurance companies was the issue with disclosures. IFRS 17 required a lot more disclosure detail than IFRS 4, not just the actual numbers, but the methodology behind those numbers. And many draft financials we have reviewed have disclosure gaps. So, in a nutshell, overall, we have seen across the board that even the most sophisticated insurers are still maturing in their IFRS 17 process. But there is also an opportunity we see. By identifying these common issues early, companies can strengthen both their financial reporting and internal controls. Now, I would like to talk about some of the lessons learned during this process of IFRS 17 audits. A key realization has been the need to build strong governance around the IFRS 17 process. It's not enough to have checks in place. What's required is a full control of framework. That means every critical step from like model adjustments to assumption updates to result review should be tied to clear ownership, proper sign-off procedures, and documented evidence. During the audit review, we often come across processes that are technically accurate but lack formal review trails or version control. The next big takeaway is the importance of engaging early with auditors. Companies that have waited until their first official filing to engage the audit team found the process far more stressful. On the other hand, firms that conducted dry runs were able to identify gaps early and get agreement from auditors on interpretation and materiality thresholds well in advance. This early dialogue makes a big difference. It avoids surprises. In our experience, some of the smoothest audits have been those where actuaries and audits were already in sync. Then perhaps the most fascinating lesson of all have been around the intersection of accounting and actuarial knowledge. IFRS 17 has brought these two disciplines very close to each other, and it's no longer enough for actuaries to only understand models and assumptions. They now need to grasp accounting standards concept like audit evidence, or they need to have a strong grip on materiality threshold when it applies in the disclosure. To wrap up, I would say that actuaries play a pivotal role in making IFRS 17 audits effective. We bring deep domain knowledge, challenge assumptions, validate model outputs, and ensure disclosures are accurate and complete. For in some markets where IFRS 17 first-time implementation is happening, the role of actuaries will become more important, especially during the dry run. Our expertise helps both the insurer and the auditor to avoid surprises. Ultimately, involving actuaries early and meaningfully enhances the credibility of financial statements and protects everyone involved in the audit process. Thank you. Raim, I would like to give the floor back to you now.
Thank you, Mr. Hussain, for a very insightful session. You explained how actuaries support auditors when they review the IFRS 17 results. It showed us how important the actuary role is in making sure the financial statements are correct and clear. Our second speaker is Mr. Murgesh Pilani, a highly respected expert in IFRS 9 domain. Mr. Murgesh brings over 25 years of experience in helping insurer and financial institution implement accounting standards alongside actual processes. He'll be speaking about IFRS 9 and helping us understand its key challenges and how it applies in the insurance world. Let's hear from Mr. Murgesh as he shares his insight.
Good morning, everyone. Hope everyone can hear me and you can see my screen. Hope everyone can see my screen. Okay. Thank you, Rahim, for that wonderful introduction. I'm going to take you through the IFRS 9. Actually, I'll try to make it much simple as possible. Um, so let's start with what is the IFRS 9 requirement. Actually, it's an international accounting standard, which governs the classification, measurements, and impairment of the financial instruments. So basically through an ECL model. So I'm trying to cover today's the IFRS 9 presentation through these points, where I'll give a small introduction to the IFRS 9 and scope for the insurance companies and classifications and measurements, and then the main part of the ECL model, how that works. And it is interaction with the IFRS 17, and I'll try to give you some key challenges what we face or what we will face in the IFRS 9 implementation. Okay, let's start with IFRS 9. What is IFRS 9? Actually, it replaces the IAS 39 because it's the IFRS 9 was more logical and forward-looking and less complex. So IFRS 9, which is focused on basically the two main elements, which is the classification and measurements, and then the impairment, the ECL model. Applicability to the insurance company, the mainly it's impact the investment portfolios and insurance receivables and debt instruments and reinsurance recoverables. So you have to understand IFRS 9 is a separate model or separate standard, which you have to do it separately alongside with the IFRS 17. I will explain you what is the connection between 9 and 17 in the slides to come. So let's start. What is IFRS 9? We have three classification or categories, we can call it. And how do you define these categories? It goes through a SPPI test. I'll explain what is that test in the next slide. So basically, we have three categories, which is amortized cost and fair value through OCI. That is the through fair value through other comprehensive income, and then you have a fair value through profit and loss account. So basically, the ECL component will cover the first two elements, which is the amortized cost and fair value through OCI. So as you know, like the fair value changes, so we don't make any changes to amortized cost, but if any changes in fair value, you treat those through OCI. And then anything treated as fair value through P&L, you mark to market. So especially example like equity investment, you keep mark to market and treat it in the account in a mark to market method. So how these investments qualify for a easier? Let's go with this. What is sole payment of principals and interest test? So what do you mean by this? Actually, the investment which is having the principals and interest component. As you guys know that what is principal, it's either the par value or the fair value of the financial asset at the initial time. What is interest component, where you have a component of time value, credit risk, liquid risk, inflation, and the profit margin. So anything qualifies in this category, you have to do a ECL test. Basically, as we said in the previous slide, the hold to collect, the investment which is hold to collect, which is through amortized cost measurement, need to perform ECL calculation. And then hold to collect or sell, again, which is fair value through OCI, you have to perform ECL calculation. So what do you mean by, like, what are the instruments? Just I'll try to put some example. Like if you have a plain vanilla bond which has a fixed return or interest income coming on payments, it passes for the ECL calculation. So investments with interest linked to inflation, again, these passes the ECL test. In instruments like the equity investments, which will be failed because it is, you have to mark to market. So this will not qualify for ECL calculation. Investment return, which is linked to the equity, again, which don't returns you any fixed income or interest return. Again, these also fail, so that you don't have to do the ECL calculation. So let me put it in the three stages of this ECL model. Basically, most of the time we use this ECL for the less than 12 month, where you have a investments or receivables, which you will put it on less than 12 months and try to do a ECL calculation for that. The worst stage 3 scenario, where you have let's take a receivable. You know for sure this receivable is not going to be going to get any return, or which is not going to be collectible, so that you have to go and do an impairment and try to arrive to the actual value and then take the difference to your P&L. So you have to take the ECL for full in that case. So let's comes to the important part of the calculation of how this IFRS 9 is performed. So basically, it has, to give you a small summary way of explaining this IFRS 9, you have this, I'll start with the receivable, which is more little complicated compared to the investment ECL calculation. So in receivable, you should have at least 5 years of your receivable on these buckets, like current and over 30 years, over 90 years. So what do? We take those total receivable and plot it in a way and arrive to a PD, which is the probability of the default. So don't get scared by these numbers which is thrown there. It normally comes with a very small percentage, 3, 5 in that range. But you have to perform your receivable and understand what is the probability of the default. So for that, as I told you, you need a historical data, put it in a model. We use a VASI-check model, which is a German model. But there are several models to arrive to this probability of default based on your historical data, what you have. Then we arrive to the LGD, again, which is a loss given default, which is again a very interesting component. This actually works basically based on what is your past experience of your receivable having falling into default. On current, how many percentage which falls as a default. So this again, maybe you have a large data to analyze and understand, to say that this LGD component, maybe the actuaries can help, or maybe you should have a lot of data to understand and arrive to this LGD calculation. Some people use the industry rate. Again, that's another method, but you can use a closer proxy in case if you don't find anything on your from your company. The investment component of ECL calculation will be very straightforward, whereas we do get the PD rate through this Moody's rating or from these credit rating companies, and whereas LGD is also given by the market factors. But again, there will be always debate will come whether the treasury bills and bonds need to be, you have to do an ECL calculation as per standard says, yes. But again, we can use a very nominal PD rate to arrive to a nominal ECL value for the investments. So let's move on to the ECL examples in insurance. As I told, the government bonds or treasury bills, all these will be performed under the ECL calculation. And premium receivable, it's a very important area where you have to work out on your ECL on premium receivable. Reinsurance recoverable, again, you have to work on the reinsurance recoverable based on the historical data. And I would say these some company do perform in a detailed analysis where they say that your receivable of industry wise and create a PD rate based on the industry defaults. So you can go to any granular level, but again, the biggest challenge insurance companies or any companies will face to have this historical information in a right form over like fast 5 years, either monthly or quarterly, so that this will give you a meaningful PD for the company. So let me come to the last or the last point of here. What is IFRS 9 and what is IFRS 17? As you know, this IFRS 9 need to be performed before IFRS 17, because you should understand that your receivable or your asset position should be into a fair value position before you go to IFRS 17. For example, your receivable is correctly stated because you know that in LRC calculation in IFRS 17, you are going to use the receivable. So you have to make sure your receivable is in correct way, or taken the ECL correctly. So coming back to the key challenges of what you face, as I told you, as I touched you a little bit in the presentation, the data availability, it's very important. You have to understand what are the historical information you have it, whether you have it in a proper format, whether you should be able to build this IFRS 9 model by using your data. So whoever in the process, the people, countries like who are into the process of implementing IFRS 9, please put attention or take attention to this area where to find your historical data and system support, especially if you going to have it in a complicated way, the IFRS 9 calculation, you need kind of a models or some system, and it should be aligned with your company's integrated system. And then the coordination with IFRS 17, as I told you, you have to perform 9, and you make sure that you do this work before you start your IFRS 17 exercise. And you have to look it from the investments on IFRS 9 point of view, because you know that ECL going to have an impact to your P&L. So you make sure that your investment decisions are taken based on the ECL output, so that you keep attention to your A-rated investments and make sure that the ECL will not bigger in those investments. So you redesign your investment strategies based on that. And finally, the interesting part where the CFOs will the role to play on this IFRS 9 project, because you have to make sure that these all aligned with you, like all the datas, and you have this proper model to input and eventually arrive to a ECL which is making sense to you eventually. So I think that's the end of my presentation. Hope I try to make it simple as possible, this IFRS 9. But we are open to any questions which you are going to throw, so we can able to answer and try to clear anything, even today or later on. I think thank you. That's it. That's the end of my presentation. Thank you for all for listening. Thank you very much.
Thank you, Mr. Murugesh. Thank you, Mr. Murugesh, for that information and detailed session of IFRS 9. As we have seen, IFRS 9 implementation is a complex and challenging process, especially within the insurance industry. That's why at DD Consulting, we are actively working with many companies to support and guide them through this journey. There's a lot of questions coming in, which we will do it in the end of this session. Now, for our final segment of our webinar, we are excited to welcome our final speaker, Mr. Nikhil Shah, joining us all the way from Australia. He brings with him first-hand experience from the market that is well ahead in IFRS 17 implementation, already navigating post-implementation challenges, regulatory developments, and involving role of auditors and actuaries. While many of us are still in the implementation or transition phase, his insight will give us a valuable look into what lies ahead. It's a great opportunity to learn from a future we will soon be stepping in. Thank you for joining us today, Mr. Nikhil. The floor is all yours.
Thank you for the warm welcome, Rahim, and thank you to DD Consulting for having me here. My name is Nikhil Shah. I'm an actuary based in Melbourne, Australia, with a background in the UK, and I've done work in New Zealand and in Australia. A fair bit of work in employee benefits, including implementation of the IS 19 changes that occurred many years ago, and then in the life insurance space. I'm an appointed actuary to Life Insurance Friendly Society based in Australia. And we've had to implement IFRS 17. And I've implemented IFRS 17 and aspects of IFRS 9. And over here, we call them WSB 17, WSB 9, but essentially the same thing across multiple clients. So without further ado, I'll share my presentation. Oh, interesting fun fact. I'm also just always worth sharing something so people remember me. I'm also a qualified registered yoga teacher as well. So I hope you find that interesting. Without further ado, I'll share the presentation. I hope you can see that. So very fancy title, Impact of IFRS 17 on the Australian life insurance market and post-implementation feedback. And that's my name that pops up. Being here today, I was invited by Hussein, and Hussein and I have been catching up for regular discussions and coffees, and that's what we do in Melbourne. We catch up for a coffee to discuss ideas. My business is McGing Advisory and Actuarial, and DD Consulting. And Hussein and I were talking, okay, what can we do to help you in Asia and the Middle East with what we've learned in Australia? So we've put together a few items of post-implementation consideration, just looking ahead, what things might look like for you. Might be a little bit different, but hopefully some of these learnings will hit home. So, as I said, this is to help you guys anticipate practical issues beyond just technical compliance. Australia's experience highlights integration and operational challenges you can plan for now. You can reflect upon what we've learned over the last 18 months and consider things that are practical for your insurer, the actuaries, and the reporting. And we can share our implementation lessons to you guys. Well, one thing that was fascinating was sort of observed. The IFRS 17 standard does not mention the word actuary anywhere in that standard. It's not mentioned at all. But for all intents and purposes, a very, very actuarial standard. So actuaries will be required, will be needed, and will drive a lot of the work behind this. In Australia went live in 2023. The implementation touched nearly every part of insurance enterprise, from the finance ledgers, the general ledgers, to actuarial models and to board reporting. It replaced an Australian Accounting Standard 1038, and it still interacts with a number of different Australian accounting standards, which are sort of the local interpretation of IFRS standards. Now, the key learnings. Now, this is a slide I'm going to just take a little bit of time on. So this is looking at what I felt my client and myself as an appointed actuary, I needed support. And here's my key learnings. And there's way more learnings than this, but I was like, okay, let's not overwhelm, but let's pick the top learnings, I think. Now, the number one learning was there is a lot to do. I myself hired external consultants. My clients hired us to assist other clients. It was a very collaborative effort. Resource planning is critical. IFRS 17 is complex. It touches actuarial, finance, systems, and senior leadership. Australia's experience showed resource bottlenecks both before and after go live. Many teams were stretched thin doing their business as usual. And then after it's done, there's underutilized staff after delivery. So external experts, especially experts that have implemented in other regions, can manage that spike in workload, reduce stress on business as usual, and advise and transfer skills to local teams. And working with DD Consulting or with my McGing Advisory and Actuarial is just one way you could do, and you may have your preferred consultants, but start planning early, and we're more than happy to share what we've learned. The general ledger, GL, redesign is more fundamental than expected. IFRS 17 fundamentally redefines how insurance contract liabilities, risk adjustments, and CSM flow through the ledger. Australian insurers some underestimated the degree of chart of accounts redesign required. The reconciliation between the actual systems and the finance GL structures were a major challenge. The big insurers, especially in Australia, we have some, it's not that many insurers, but the insurers that are here, a lot of them are backed by Japanese capital, and they take a very long-term view, and they started very, very early. I took it very seriously. And then the smaller players, rightly or wrongly, and I think it was quite smart, waited till the last minute or quite late to start implementing, so they could use this learnings from the bigger insurers to help with their implementation. Mapping sub-ledger to general ledger structures early can avoid painful rework later. That's probably the message there. Now, reinsurance is complicated in IFRS 17. The reason being, reinsurance contracts do not necessarily align perfectly with direct portfolios. Loss recovery asset logic under IFRS 17 was especially poorly understood initially. Many Australian insurers had surprises late in testing. The contract boundary, and this is, it'll come up in IFRS 17, for certain contracts might be under 1 year, but the reinsurance is a 5-year or ongoing contract. So you have this mismatch in the duration of the reinsurance and the insurance liabilities. So yeah, bring in subject matter experts can help look at your reinsurance frameworks from day one, including how things should be assessed for contract boundaries. And then that sort of moves on to the contract boundaries assessment. Contract boundaries need early, well-governed decisions. Under IFRS 17, they drive measurement, coverage units, and cash flows. This is all IFRS 17 speak. Certain Australian entities took a little bit long to lock in the policy positions, and leading to confusion, rework. And that was my experience as well, taking a long time, thinking, oh, it's just an accounting standard from certain aspects. And then the auditors came in and said, well, actually, no, you need to look at this in this detail. And auditors in Australia have actuaries on their workforce, and they had very strong opinions as certain auditors, especially the Big Four, where they would sort of sometimes say, oh, the global position coming in from the UK is you must do it this way. This led to sort of confusion, rework, and sometimes consistency with it, internal pricing frameworks. Engaging early with, policy design and documentation can give your management confidence and getting auditor buy-in early. And I think that was really a good learning position. Certain auditors were very light touch and they relied upon the actuaries as the expert, but others with actuaries in-house, with global entities, had strong positions. And interestingly, if you look at Big Four, one of the Big Four might take a different position to another of the Big Four. Accounting policies and judgments were critical, and they must be robust. IFRS 17 requires a wide range of new accounting policies and significant management judgments. So some of the topics are risk adjustment methodology, discount rates, how coverage units are to be determined, the CSM allocation. And quite importantly, it was in Australia, it was a fully retrospective standard. So we had to do comparative and look back historically, and with a transition obligation, make a decision whether to do one of the 3 options that were provided, which was fully retrospective, modified retrospective, or fair value. Combined with all the multiple cohorts, there's a degree of complexity there. So looking at this early and engaging early, you may find that there's simplification that may assist with that. These judgments were heavily scrutinized by auditors, and sometimes the auditors challenged late into projects. Lack of documented policies slow down approvals, introduce risk, and delayed sign-offs. What we can do is to help develop good governance, assist you with your board or management to get approval for these policy frameworks. And with this governance files, try to avoid last-minute surprises and ensure audit readiness. Acquisition cost treatment can shock profit profiles as well. The treatment of insurance acquisition costs, cash flows under IFRS 17 is quite different to traditional DAC. This directly affects how commissions and distribution incentives appear in P&L. Several Australian insurers were surprised by the profit volatility. Scenario modeling and stress testing acquisition cash flows early would assist with that. Now, with all of this complexity, people had to change their general ledger, they changed their profit modeling or their valuation system, but it didn't give everything that was needed in the format. So what happened? Spreadsheets. Everyone jumps into, okay, I'm going to just develop a spreadsheet that fixes, that puts this square peg, I need to report it in this format. Spreadsheets were used. And actuaries are very good at this. And over time, there's one spreadsheet, then it needs another fix and a small fix, small fix, small fix. And these were the glue between the actual valuation and IFRS 17 financials. These can be quite highly manual and error prone and difficult to audit. So speaking to CFOs and appointed actuaries, they view this as ongoing risk and cost, and helping, and maybe this is post-implementation, looking at automation, scalable and controlled reporting frameworks to avoid spreadsheet, proliferation. Now, the bridge to other reporting. Boards, regulators, senior managers still rely on embedded value, experience, profit, and traditional key metrics. IFRS 17, by God, it's gobbledygook when you first see it. They do not automatically align to these metrics. So the position is, how do we explain what we've done historically and how can we reconcile it with IFRS 17? And I think it's just a case of doing a bit of stress testing, and it's not a case of saying, well, okay, here's our old basis, here's our new basis, difference analysis. It's such a different standard, it's almost alien. And people did say, okay, we can't reconcile it, but we will try our best. So designing the reporting bridges and reconciliation tools, yes, have a look at it, but it can get very, very complicated because things are done very differently under IFRS 17. And there's a lot more granular reporting. So, but where we're at today is we've got, we're in the third or certain insurers in the fourth cycle of IFRS 17, and they're starting to see the patterns emerging and reconciling the IFRS 17 reporting with itself. But that's taking 3 or 4 years to sort of build up to it. Now, regulator focus. Unlike some markets where regulators might lead the implementation, our Australian regulator, APRA, kind of took a step back. They are focused on capital implications, not the accounting, and left compliance largely to auditors and internal teams. It didn't require actuary to sign off on the stat reporting, but it was auditor-led assurance. However, they changed the reporting such that it's aligned to IFRS 17, to the regulator quarterly reporting. So they require quarterly profit and loss, balance sheet, and the liability roll forward at a high level, and align it and find a way to align it to the capital reporting standards as well. So it's sort of integration, but not focus on the IFRS 17 aspect. With 3 reporting lenses. So we've got the capital that I've mentioned from the regulator, which is the capital reporting. Over here, we have something called the LAGIC framework, life and general insurance. Not too dissimilar to other capital regimes. The regulators focus on high degree of capitalization. The auditors, the statutory reporting accounts is now IFRS 17 compliant, which might be different to your markets. as I understand it. It will be all the accounts going forwards are now under IFRS 17. And we had to do a reconciliation back 1 year. So it was implemented in 2023. We did a reconciliation in 2022, which basically, I'm not an accountant, but start off with where you were, close that off, and then reopen in 2022 with the IFRS 17, and then you have your comparative year, which is going back 2 years. Now, management, if you look at a life insurer, how do we measure profit? And that launching a product is looking at profit. And so IFRS 17, looking at things on an annual basis, doesn't necessarily give you the profitability. And some of that we've mentioned is due to the way acquisition costs are treated. So management are still looking at the traditional metrics, embedded value, and it's very helpful to make management decisions on that. However, looking at how things might apply in your statutory accounts would be a consideration, as well as your capital figures as well. Now, these three things might not necessarily reconcile, but looking at all three can give management that comfort. EV, traditional metrics, how profitable is everything, and then looking at how it will look in their accounts for shareholder reporting and for capital for regulatory reporting. One lesson, don't underestimate the ongoing cost and effort of producing and reconciling three financial views, especially where internal KPIs can diverge from the IFRS 17 outcomes. Where we're at today, you can expect significant resourcing demands. I've touched on this. You have to balance fast delivery with long-term control issues, especially due to reliance on spreadsheets. What's happened now? Those actuaries that implemented that, there's an oversupply of life insurance actuaries. There have been retrenchments at consulting firms, redundancies or retrenchments at life insurers as well. Now, there's also 3 sets of parallel reporting, and there's still heavy spreadsheet use to transfer. And ledger updates have added to the cost. And sometimes it's still in spreadsheets and the ledger has not been updated. The key operational pain points, data quality, and I think everyone can attest to how bad data can be. Model complexity. The more models you have, the more changes you need to make. And the external solution limitations. So I'll touch on this. Big players their tools didn't always deliver. In some ways, many firms struggled with the transparency and to get local support from multinational black box tool that might have been sold to them. And that may well be because we were implementing in Australia and we're a smaller market to bigger countries in Europe and USA. Well, not USA, but bigger countries in Europe. So we didn't get the support necessarily that we expected. Our clients didn't get the support they expected. So evaluate your vendors carefully, especially if you're looking for an external solution. And I'd say, especially if you're not a tier 1 player, if you're a smaller insurer, you may not get the support you expect because there's more of a focus on the bigger market players. In Australia, we had an audit-led compliance model. Be prepared for differing views between audit firms and internal teams. Now, it depends if they've got actuaries. Now, without regulator standardization, auditors became the de facto enforcers of IFRS 17 quality in Australia. And the work was done by the actuaries. There's diverse interpretations of how things are done. I went to a presentation with the head of the IFRS board, who'd come in from Switzerland. And his expectation, yes, there'll be lots and lots of interpretations. That's okay. But over time, there will become a consensus view, and that's expected. So there might be diverse interpretation now, but slowly, they'll narrow it down and give clarity over time. Now, ensure your management needs versus your statutory output. IFRS 17 is too technical for internal use, but you need to understand it because that's how your P&L may be reported. Ensure your internal frameworks don't get lost. IFRS 17 doesn't replace the need for traditional views of value. It just adds a new layer that often confuses stakeholders unless it's carefully translated. And even if it is, board members are not going to understand IFRS 17 reporting. Now, where to from here? My advice, if you'd like to hear it, don't stop at day one compliance. Australian firms are simplifying and refining. There is a window post-implementation where you can fix your technical issues and improve efficiency while you've got the headspace. But what happened in reality is everyone was exhausted. The internal actuarial teams was, stretched thin. Everyone breathes a sigh of relief when the first run is done, and then 6 months later, you've got your 6 months reporting. It doesn't end. So once you've got to the end, shift from implementation to optimization, look to automate your spreadsheets, integrate capital and value views together, and improve your controls and efficiency. A good governance and documentation early on can help with some of these challenges. So I've talked for a fair bit. What's my key takeaway summary? IFRS 17 improves consistency across reporting across all insurers because they're reporting on the same standard, but it's extremely complex. There's a lot of work. The operational load is going to be high. Support is needed and support is available. Learn from Australia's path. Technical compliance is just the beginning. Success comes from integration across accounting and finance, actuarial, and bringing your leadership and management team along the journey. Thank you very much and appreciate the time you listening to me from Australia. And I'll hand it over back to the DD Consulting and Rahim, and really appreciate this opportunity to speak in front of you. Thank you, Rahim.
Thank you, Mr. Nikhil, for sharing your experience and lesson with us. It really helped us to hear what's happening in the country that is already ahead. Your insight will guide us as we move forward in our IFRS 17 journey. We truly appreciate your time and contribution. As we have seen, structural planning, dry runs, early regulatory dialogue, and cross-functional teamwork can significantly influence the success of the implementation. We truly value your feedback. Before we start our question and answers, please take a moment to complete the feedback which is mentioned in the chat, or else you can send us an email. Our email is already mentioned in the chat box. It will influence us to make tailored, future webinars as per your needs. Also note that we prepare a variety of insurance industry reports tailored for different markets, including UAE, Sri Lanka, Pakistan, and several other countries. You can share with us and we will share it in our email to you. Now we will have our question and answers. The first question was asked, how do discount rates, risk adjustment, and CSM interact to influence profit timing under IFRS 17? And what key actuarial judgments drive constantly in the application? I think so, Mr. Hussain, if you can, you're on mute. Yeah.
Sorry. Can you, Rahim, sorry, if you can repeat the question?
Sure, I'll just do that. So how do discount rates, risk adjustments, and CSM interact to influence profit timing under IFRS 17? And what key actual judgment drive consistency in their application?
Okay, thank you. I think this is a very important question, and it touches on all the key elements of IFRS 17. So all three, like the discount rate, risk adjustment, and the CSM are like all three are major elements, and it affects the timing and the pattern of profit emergence. And more importantly, I would also say they are like very interconnected. So it influence one could influence the other, and ultimately how profit flows through the income statement will be affected. So briefly, I'll start with discount rate. And this is essentially the present value of future cash flows. So a lower discount rate obviously increases the liability and vice versa. More importantly, in IFRS 17 context, it also affects the interest accretion on the CSM. So, like CSM is unwinding of results over time using the locked-in discount rate. So, the choice of discount rate directly affects how much profit is released in each period. Then the second point is the risk adjustment. So, which essentially means that the compensation the insurer requires for bearing uncertainty. So, higher the risk adjustment implies that you are kind of doing a higher deferral of profit. So, it is a release. It is the release pattern over time. As the uncertainty reduces, the risk adjustment gets released into profit. So again, our assumption on release pattern shapes the timing of profits. And the third would be the CSM. So CSM is the unearned future profits from the group of contracts. It is released over time as the insurer provides coverage or services. So the any assumption that affects the allocation of coverage units, like how you define the coverage units, will impact the pace of profits over time. And in summary, I would also say that the actual judgment plays a key role here because you are talking about setting the assumptions, justifying the consistency across different components, and also ensuring that they reflect the economic substance, of the contracts. Thank you.
So our next question is how to compete LGD for insurance-related receivables.
Um, hope you can hear me. Hello, hello. Sorry. I hope everyone can hear me. It's okay. It's audible. Okay. Actually, the question is about, it's a good question. How do you arrive to this LGD of the receivable? Actually, that you have to have a historical data. Basically, you have to work on your default of your receivable based on your historical data. So basically what insurance company does, they have to have a historical defaults happening on different buckets so that you have that information to arrive to this LGD. So as I told you, like sometimes company use a kind of a proxy in this area to arrive to a reasonable industry default rate, and then they use a proxy as that industry and use it. So, but eventually, if you want to do a scientific way, you should go back to your historical data of default and find out this LGD. Yeah. So there is another question also asking about how many buckets you have to keep it in the receivables, like what are the receivable buckets you should keep it. Actually, that is a good question. Again, you can keep it as much as, like we'll say, if you have more granular level data, you will have the PD very accurately, because eventually you are going to summarize the PDs on kind of an averaging on the PD on based on the buckets. But if you have a more data with the monthly the aging or quarterly aging, so you will be able to get a very accurate PD calculated for the company. So it depends on what you have available in your company. So that's an important thing.
So there's one more question. What is ECL?
It's a accepted credit list, so that's already there in the presentation. And I try to share. Can you hear me? Can you hear me? Yeah. So I'll try to share the presentation. We'll try to share wherever it's possible. Some people asking the presentation, we'll try to work it out on that. But if there's any other questions, please send us that we should be able to answer. If there's any specific question which is connected to your company, please send it to us so that we should be able to answer those questions. Okay.
Is IFRS 9 applicable on IFRS 17? I think so, Mr. Hussain. Mr. Hussain, you're mute. Sorry.
Sorry, so I understand that IFRS 9 is applicable on IFRS 17. That's the question? Yeah, okay. So actually, these are two different standards. So IFRS 17 talking about insurance contracts and IFRS 9 talking about the expected credit loss. But interestingly, the timing of the implementation has coincided, and there were companies were allowed to adopt IFRS 9 earlier, but most companies have deferred the early adoption and they have gone with the implementation of the two standards together. Sometimes I feel that even though IFRS 9 itself warrant quite a lot of understanding and discussion, and it is a standard in itself, but because the implementation happened together, it never got the respect that it demanded. So, and companies are even though they are working on IFRS 9, but there are gaps in the understanding and the implementation, correct implementation of the standard, because everything has to be implemented together. But in short, like these are two different, very different standards.
I might interject. Can you hear me? Yeah.
Yeah. Yeah.
Yeah. So IFRS 9 is the financial instrument standard, and I talk about Australian experience here. For some of my friendly society clients, they avoided and avoided IFRS 17, which is far more compliant, and implemented IFRS 9, the financial instruments, by examining the contracts and determining that actually they're not insurance contracts per se, they are financial instruments, which reduce the burden of regulatory reporting. Now, it's quite specific. It might be specific to this friendly society rather than the life insurance. But I saw a comment from Mary Lee's that mentioned takaful might be, similar to friendly societies. So it's a really good question to examine. Can IFRS 9 apply to those commitments that you've made to your policyholders? Is it really a financial instrument or is it an insurance contract? And it's a question to look through, and various contracts themselves may be classified under IFRS 9. I'm not sure if that's applicable in all your regions, but that might be something to discuss, and I'm happy to discuss offline if anyone believes they might have that. And yes, and IFRS 9 can apply to the asset side as well, the financial assets, the financial liabilities and loan commitments.
Okay. Are there any insights in respect of application of IFRS 17 and IFRS 9 to takaful contracts?
I think the implementation on takaful is an area which is still, I would say, evolving. So there are different practices in different countries. So, for example, UAE has adopted IFRS 17 even for takaful companies, and the companies themselves have been making some adjustment to account for takaful treatment. But whereas the other countries like Oman has adopted AOFE standards. So AOFE has issued FAS 42 and 43 with respect to takaful. Though those FAS 42, 43 were issued in I think year 2022, and the first implementation was required in quarter 1 2025. So interesting case was Oman, where the conventional companies adopted IFRS 17 earlier, but the kafil companies were allowed to defer the implementation because they were going with AOFE FAS 42 43, and just this year Oman has adopted AOFE standards for the kafil companies. So this is an area which is evolving. I think there will be more clarity as we move forward. And generally, when it comes to IFRS 17, there is even though it's a principle-based standard, but there are learning that you can transform from one market to other. But the kaful is one area where I've seen that because of the adoption of different standards or different approach by the regulator, so learning from one market to other can be a challenge, and more clarity will come as in the years ahead.
Have different IFRS 17 implementation in the Takaful companies as compared to conventional, especially on SH and PH funds? How different?
Oh, I think this for both like PTF, I would say the implementation because PTF deals more with the insurance cash flow and the underlying mortality risk. So the implementation is closer to the implementation for conventional companies, and all the concepts are applied. The operator fund is where things are not very clear, and or the shareholder fund is where things are not clear, and it is depends on which country you're talking about, or how the company is planning to apply the model, because the operator model, whether it's Wakala model or Mudarba model, whatever model they have adopted. So I think IFRS 17 uh, is not fully transferable to the operator side. So this is where more thinking is required. And I would say when we apply, or when we ourselves implement IFRS 17 for the Kaful company, so we have to divide the implementation into two separate grouping. And for PTF, we take a different approach, and the approach where you have to work with the cash flows and the risk adjustment, etc. But the other approach for operator fund is where you have to look at the clarity from regulator, understand the underlying model of the company, and then look for and sometimes also look at the market application, that how other takaful companies are implementing before you agree to a final approach.
Okay, we'll be just quick on some questions because there are a lot of questions coming in. We'll answer to all of you guys. Just fill up the feedback form or the email address, and we'll reply to all of you guys. There's another question. A company has both insurance contracts and investments, financial assessed. How do IFRS 9 and IFRS 17 work together to show profit or loss in the company financial statements?
I think as I said, both standards are different. So IFRS 17 implementation is more on the insurance components, and IFRS 9 is more on the talks more about the expected credit loss and the impairment. The application depends on, I would say, first the underlying business that the company has. So if it's a life insurance company, then we look at what sort of products they are selling. And I will keep it high level that in the past, in the previous standard, the underlying product that the company was selling may probably not have anything to do with the underlying valuation model that the company adopts. But here in IFRS 17, if you are selling short-term products, then you have to deal with PAA approach. If you are selling long-term products, which are not participating products, then you have to deal with GMM, but you have a possibility to, if your PAA eligibility test is passed, then you can apply PAA. Then you have to deal with discount rates. So a number of things affect your profitability and P&L. And even the first time transition, whenever you start with IFRS 17, so there is a impact on your equity which you have to deal with in the transition phase. So a lot of factors, yeah, affect your P&L or the profitability in general.
There's a question for Mr. Murgesh. Which model is used other than ECL for equity released assist in SPPI test fails?
Okay, I'll take this question in a different way. SPPI test, you have to do it to identify whether you need an ECL or not. So anything which is passes SPPI test, you have to do an ECL. That is the rule. And whatever it fails, for example, then those instruments you normally do mark to market. So that will be fair value through a profit and loss account. So, but when you're asking what model we use for ECL, actually we use a Vasicek model, which is a German model, which consider of many factors like your countries. It's a country specific model because you have to localize according to the country's the GDPs and inflation rates and many other factors. So what we do, we use basic check model to understand, depends on the country's the information. So we feed and arrive to the answer through the model. So there are many models, but we were using a Vasicek model on ECL calculation. So I hope that answers your question.
Okay, the last question is, what key challenges have you observed in applying IFRS 17 measures models of takaful contracts? I think that that's already answered, right? Or there's
Yeah, maybe. I think Takaful, I think people have a lot of interest, and maybe rightly so because the things are not very clear. So I would say the very high level, the key challenges would be that first is the underlying structure of Takaful, that you are dealing with dual fund structure. So there is one participants fund which is dealing with all the insurance component, and you have the shareholder fund which is dealing with the profit and the expenses. So this is the first structure. First challenge, that within a company you have to the funds are segregated and you are dealing with two different categories of funds, and you are in a way like you are doing two implementations for one company. The second would be the appropriate measurement model, so PAA, GMM, VFA, etc. So while thinking about that, you have to think whether the how significant is the risk sharing or the investment link component. So it becomes a little bit tricky when you think about the takaful cash flows. So you have to go a little bit deeper in the measurement model application. Another challenge, I would also say CSM or the coverage units here, because you have to look at the because the operator is not taking on any direct insurance risk. So how do you define the coverage units and the CSM amortization? Um, and I would say the biggest challenge is the lack of clarity or guidance within the IFRS 17 standard. So because the standard doesn't cover or address the takaful contracts, you have a standard from AOFI which does address, but the application differs by country to country. So the standard application as it is of AOFI standard is also not possible, looking at some of the countries' regulatory framework. So this, I would say, is the biggest challenge, that lack of guidance, and because the standard does not give full guidance, then we look for guidance from the regulator, and that's where every regulator in different markets is of issuing its own set of guidance and clarification. Thank you.
Hussein, I might just jump on that. With the takaful, what you've mentioned, the separation between uh, members' funds and the shareholder fund for takaful contracts, that's very similar to a friendly society. Um, Essentially, the way a friendly society works and where we've implemented IFRS 17, the the participant funds pays expenses, the fees to the shareholder fund. So it's a management fee, and then the fee itself, the expenses are paid out of the shareholder fund, and there might be some direct expenses from the policyholder fund. It was a very interesting look at things. We had to look at it. IFRS 17 and the accounting standard does not look at the member from a member perspective. It looks at an insurer perspective. So you have to look at what's happening overall to the insurer and thinking about negating those cash flows that are occurring internally from policyholder to the shareholder fund. So you have to sort of offset those, but look what's actually happening at an entity level, what's coming in and what's going out. And beyond that, doing the contract boundary, that was very, very important. And look, I think Hussein touched on really well is doing that assessment. Does VFA actually apply, and how to test for that? And we've done that in a number of ways, doing a VFA eligibility test, and whether it is actually, participating a discretionary participating fund, and how to test for that. It may look like it, but it may not pass the test depending on the level of fees and returns that are passed to the member. But I'll pause there and thank you.
Thank you everyone for joining in. In the end, for vote of thanks, I'll invite Mr. Murgish to say a few words.
Hi, thank you everyone from attending this webinar from UAE, Pakistan, Sri Lanka, African countries, and other part of the world. Thank you very much. And as you know that we DD Consulting, which is into this IFRS 17 projects and IFRS 9 project for a long. So if you need any help or assistance, please reach out. So we are very happy to assist you, because we have gone through many quarters of IFRS 17's implementations and gone through many companies' works. So thank you once again for attending this webinar, and we're looking forward to see you in another webinar. Please share us if you need anything specific to the country related or any specific areas to be discussed. We are really open to do that one. Thank you once again. To have a good week ahead. Thank you. Thank you, guys.
Thank you.
Thank you everyone for joining in.
everyone.
Thank you, everyone.
You can send in your messages, you can fill in the feedback, and we'll reply to you all.
Thanks, everyone.